Hi everyone, and welcome back to the next lecture of the chapter. You've learned a lot about the different types of savings options so far, and now we're going to step back and do a comparison between the two registered accounts we covered, the TFSA and the RRSP, as well as their US counterparts, the Roth IRA, the IRA, and the 401k. Now that we've gone over the TFSA and RRSP, which one should you use? Should you use both if you can? And the short answer is, it depends on how much money you make. Ideally, you should max out all of your registered accounts if you are able to. However, in the case that you need to choose one to max out first, I've done some work to determine which account I think is most beneficial to you. I just want to preface this with, this is my opinion and through my own experience and lots of research, but there could be scenarios where the analysis I'm going to do might not be applicable to your particular situation. So please make sure you do your due diligence to ensure you understand the implication of putting your money in one account over another. With that in mind, let's compare the TFSA and RRSP side by side. Okay, so TFSA and RRSP, let's go. So when am I eligible to open the account or to start investing in it? For the TFSA, we have to be 18 years old, and for the RRSP, we just have to have taxable income. How much can you put away per year? So in the TFSA, currently, as of 2018, you put in $5,500, no matter what you make annually. And for the RRSP, it's 18% of your gross income, or $26,230 as of 2018, whichever one is lower. What can I do with the account? So both of these accounts are really used to invest. You can hold cash in them, but mostly these are investing accounts. And what are the tax benefits? So for the TFSA, it's tax-free income versus for the RRSP, it's tax-deferred income. And when can I make a withdrawal, or when can you make a withdrawal? So for the TFSA, there are no restrictions on withdrawals, whereas for the RRSP, you can make them when you're in retirement, which we'll talk more about later about the nuances of that, and also for the lifelong learning plan or from the home buyer's plan. Okay, so this was a nice comparison, but it doesn't really answer the question of which account you should fill up first. Now, from my research, experience, and analysis, I believe that filling up your TFSA first is most beneficial. And here are the reasons I think this is the case. First, as a young adult and/or student, it is very unlikely that you are in a high tax bracket. This means that the amount of taxes that are deferred and seen on your tax return are relatively small compared to what they could be in your future. In fact, one of the main advantages about the RRSP is that you can defer taxes while you're in a high income tax bracket and take out money from your RRSP when you're in a low income tax bracket, i.e. in retirement. Therefore, while you are young and in a low income tax bracket, it is not very advantageous to defer your taxes to another time in your life when you'll be in a higher income tax bracket. Okay, so the second point. If you are unable to contribute the maximum amount into your RRSP, which is 18% of your annual income, then this leftover amount gets banked and you're able to contribute this leftover amount at any point in time into your RRSP, as well as the additional amount you're able to put in each year. So basically, while you are not making a lot of money, you can bank all the money you are eligible to put into your RRSP and use it in the future when you have a higher income. For example, if you make $60,000 a year for the first 5 years of your career, you can put away a maximum of 60,000 times 0.18, which is $10,800 a year. Let's say you are only able to put half that amount away each year, which is $5,400, and the other $5,400 you're putting into your TFSA. But let's not worry about that for now. So this means after each year, you are banking $5,400 of extra room in your RRSP, which means after 5 years, you have banked $5,400 times 5, which is $27,000. So let's say in the 6th year of your work, you now make $70,000. This means you can put 70,000 times 0.18 equals $12,600 plus the $27,000 you banked, which equals $39,600, all into your RRSP. Not only this, but you are now taxed on $70,000 minus $39,600, which equals $30,400 of income, which puts you in a lower tax bracket than you were at $70,000 of income. Of course, there is still an argument that you are losing out on the money you could have made through your investments if you did invest the extra amount the extra space you had, which is that extra $5,400 of room over the past 5 years. But again, we're looking at a scenario where you have to choose between putting some money in your TFSA and some in your RRSP. And so the money you didn't use to fill up your RRSP went to your TFSA, so it clearly was not being wasted. By not putting money in the TFSA, we do not bank the same sort of tax advantages we do with the RRSP. So the third point for why I think, again, the TFSA is the best account to fill out first, is that the thing about the RRSP is that we do not know how the government will change the tax brackets in the next 40 to 50 years. So we cannot be absolutely sure that our tax bracket will be substantially lower when we retire, although it is likely, given the history of taxes, that this will kind of remain the case. And fourthly, you will always need to pay taxes on the money withdrawn from your RRSP. Your TFSA, on the other hand, will never be taxed once it's withdrawn from. This gives the TFSA more security if you choose to withdraw from it during retirement or earlier. So the most logical thing to do while you are young and are already in a low tax bracket is to try and max out your TFSA first, and then contribute to your RRSP. That being said, the investment opportunity and compound interest works the same for both accounts while the money is in each respective account. So the earlier you contribute to both, the more you can reap the benefits of both. Okay, so now let's take a look at the US accounts. So we're going to be looking at the Roth IRA, the IRA, and the 401k, and let's dive in. So again, when are you eligible for each account? The Roth IRA is any age, the IRA as long as you're under 70.5, and the 401k as long as you're working for a company that offers the 401k or have your own business. How much can you put away each year? So for the Roth IRA, $5,500 in 2018, the IRA, $5,500, and the 401k, $18,500. What can you do with each account? And all three are really investment accounts. Yes, you can hold cash in there, but again, mostly used for investing. What are the tax benefits? So the Roth IRA is tax-free income, whereas the IRA and 401k are tax-deferred income. So when can you make a withdrawal? So from the IRA, you can withdraw contributions at any time, but can only withdraw earnings after age 59 and a half, penalty-free. And for the IRA and 401k, you can only withdraw money after age 59 and a half. Otherwise, any money withdrawn, both contributions and earnings, will be penalized. So based on the above logic we discussed for the comparison between the TFSA and RRSP, the account we want to fill up first here in the US would be the Roth IRA. This is because in the beginning of our careers, again, we are usually in a lower tax bracket, so the tax-deferred options do not generally bring in the same benefits that the tax-free options do. If we have money left over to put away after we fill up our Roth IRA, then the next best account to fill up is your 401k. This is because you can put a larger amount of money into this account, which results in larger amounts of tax deferrals, which results in more tax savings. Also, sometimes your employer will match your contributions up to a certain amount. Depending on the amount they match up to, it could be in some cases more beneficial to put enough money into your 401k that you max out the amount an employer would match, and then you max out your Roth IRA, and then finally you can come back and fill up your 401k. Now, there are a few subtleties here. It is important to look at the expenses associated with the 401k for the company you're with versus for those of an IRA. Also, if you plan on switching companies, your 401k comes with you, but the 401k plan at another company might not be as good as the one at the current company you're at, and this could hurt your future returns. So as a rule of thumb, after maxing out your Roth IRA, maxing out your 401k is a good approach. That being said, make sure that you ask your employer about their 401k setup and compare that to the IRA option. And make sure that you feel comfortable with what you're putting yourself into, because you won't be able to touch that money you put away penalty-free until you're 59 and a half. Alright, so that covers the comparison of the 2 for the Canadian accounts or 3 for the US accounts, different registered accounts that are all designed to help you grow your wealth. Throughout the rest of the course, we're going to be discussing the whys and hows of investing, but it's important to note and understand where you're going to put all the money you make over your career from your job and investments. So this was really the purpose of this section. So if you're ever trying to remember which account should I put this money into, Feel free to come back and check out this entire chapter so that you get a nice refresher on the rationale for where you should be keeping your money. There was a lot of information here, so don't feel like you need to memorize it all. The fact that you have learned about each one of these accounts thoroughly will make the next time you review it a breeze. Also, before we finish, you might be wondering, okay, well, what if I still have money left over after investing in both of these registered accounts that I would still like to invest? Well, if this is the case, and great job by the way if it is, then you have two major options. The first is to put some of this money into your savings account. Now, you would not put this money into your savings account so that it can just sit there. You'd be putting it in as a holding place while you save up enough money to make some other type of big investment, such as investing in real estate by purchasing an income property or a house. And we will talk about this later in the course. The other option is that you can open up what's called an investment cash account. This account is one where you can put as much money in it as you want each year and take out as much money as you want each year with no restrictions. In this account, you can make investments in the stock market, which we will cover a lot in the next chapter. However, there are no tax benefits with this account. The money you put into this account will have already been taxed, and any money you make in this account, again known as capital gains, will be taxed as well. Again, the reason we generally want to fill this account up last is because there are no tax benefits we receive from it. Alright, well that sums up the comparison of all the accounts. I'm happy to say you now know the benefits of each account and where you're going to start putting your money as you progress through your careers. Thank you so much for joining, and I'm looking forward to seeing you in the next lecture.